I am joined by Thomas Lee here, Chief U.S. Equity Strategist from JPMorgan Chase. And Tom, let me ask you first of all your reaction to, well, the market reaction to Washington, because what's been going on there is obviously not very orderly. There's no decision there. There's no leadership. On the other hand, we haven't seen a huge sell-off, the likes of which we saw when the first TARP vote failed.
That's right. And I think markets will do a lot worse if the vote does fail. If we don't get it, if we have a debt default, we're going to see a lot of damage to markets.
Now, that's a huge leap, though, right? From no decision in Washington to an actual default means that Treasury decides not to pay the interest on bonds. Why would they ever do that when they have enough revenue?
That's right. So that's why the market, in the meantime, sort of sitting and waiting, trying to understand how to discount this. You know, this week we've had some disappointing data, especially from industrial companies. So the macro and the micro haven't been all that great. But I do think all eyes are on Washington this weekend. You know, I mean, the critical votes are tonight. And then I think next week we're going to have to start thinking about how markets will react if we actually get a debt ceiling increase. And of course, then we think about forward.
Hey, Tom, just quickly, I mean, you've got a pretty bullish forecast out there. Is there something that Washington could do or not do next week that would make you change your forecast here?
Well, Carol, you know, for markets, markets are pretty resilient. So if we end up with a debt ceiling increase, even the damage to confidence for business and consumers is pretty short-lived. So I think, you know, 1475 is not an issue. But if we actually have the Treasury Department having trouble paying our interest payments, I think that's a real threat to our thesis. I mean, we would have to re-examine it at that point.
Although that's terribly unlikely, isn't it? And you can see that reflected in the markets. Let's go ahead and take a look. You saw the closing bell ringing behind, or you heard the closing bell ringing behind us. Let's take a look at where the Dow is closing. Indeed, it'll be down about 100 points right now. 12,143 is the level there. We see the S&P closing down about 2/3 of 1% at 1292. So closing under 1,300. A lot of traders down here, I know, were looking for the S&P to edge up over that level at the close. It did not happen, as we said, as some big traders with long positions flatten those out going into the weekend. You see the NASDAQ right now closing down about 1/3 of 1% at 2756. So a disappointing day, not as disappointing as maybe it could have been were there an actual catastrophe in Washington. What about the economic picture, though? I mean, the GDP numbers were very weak, much less than expected. They came out today for the second quarter. Personal consumption was almost non-existent. What do you say to this soft patch growing ever softer?
Well, I think a lot of people that we spoke to today about GDP really pointed out, listen, we've got basically zero growth in the first quarter and barely 1% in the second quarter, yet corporate profits grew 22% in the first half. So I think it's really highlighting some sort of decoupling taking place between government figures and how businesses are doing.
Businesses are getting more international in their revenue, right?
Yes, but it doesn't explain everything, because as you know, retailers who are really domestic focused have had great quarters. And I think part of this has to do with the inflation factor, right? Because remember, this is real GDP, whereas corporate profits are nominal. But it's also, I think, consumption, at least from the way it's measured by businesses, is actually doing slightly better.
Let me ask you, what about the composition of what we finally get from the folks in Washington, what lawmakers ultimately, hopefully, come up with? I mean, how important is the composition of what they come up with in terms of dealing with the debt ceiling and dealing with the outstanding debt that we've got and dealing with the deficit? How important is that to you in your outlook?
Well, Carol, you know, it's going to be incredibly important for U.S. outlays to actually shrink. You know, I mean, U.S. spending is 25% of GDP. It's only some levels you've seen during world wars. And, you know, the biggest things to cut there really are, some of the entitlements, as well as some of our spending related to Afghanistan and Iraq. So it's, I think those are critical. I think there's going to be, less importance to see taxes raised. I think really accomplishing these cuts is really going to come from lower spending. But, again, the devil is in the details, as you're saying. And, as you know, both proposals really have a commission set up to actually examine these down the road.
What does it take, Tom, for you to get less bullish? I mean, we had GDP and personal consumption missing. We have total indecision in Washington, although if they decide anything, it's going to be to cut government spending. That can't help this soft patch get any stronger. We've got, Michael Siri is not alone in expressing sort of disgust at what's going on in Washington. Steve Roach says smoke and mirrors, accounting tricks. It's all a giant house of cards that would make me feel like difficult to sleep if I'm bullish here.
Yeah, well, it's been a very difficult week, actually. But, you have to remember, the business cycle is driven by animal spirits, and we know businesses are expansionary. We know consumers are spending. So I think a shock that would actually get consumers to contract, businesses to cancel orders is really the biggest danger. And I think, default is clearly one of the options. But a shock like that is really what would be a real threat. Now, you have to remember one thing I think people are forgetting is, bank credit conditions are beginning to ease. So in the second half of this year, we might start to see a slight tailwind as bank credit starts expanding. And again, that boosts growth.
Hey, Tom, it's Julie here. I want to get more details on your bullish scenario here. I did a quick math. It looks like with that 1475 target, that would be about 14% or so higher from here on the S&P 500. And you talked about strong profits as being one of the drivers behind that. And yet, this year we've had strong profits and the market's kind of been all over the place. It hasn't guaranteed gains, in other words, in the S&P 500 if you're looking at 2011. So
sure.
How are you going to get those two things back in alignment? How are investors going to, in their minds, get them back in alignment?
Well, I think the fact that the market actually has managed gains this year, despite sovereign credit issues, a huge downward revision in GDP, and of course what's going on in Washington, really speaks to the fact that stocks are cheap. We like to look at equity risk premium, which is still at 50-year highs. I mean, that tells us that when you think about what you want to own, it's not necessarily high-grade bonds. I mean, equities are the cheapest asset class. And with regard to earnings, you look at the first half GDP of being almost less than 1%, yet earnings growth is 22%. As of the third quarter, annualized earnings are going to hit 100. So we don't think 105 next year is a stretch. And so if you do a 105 and then a 14 multiple, that's our 1475 target.
I want to quick